Hi guys, I'm Arjun and I am here to discuss about the economics of the crude oil crash. So as we know in the current market scenario, all of the global asset prices have been falling and that too on a daily basis more. And if you see crude oil, this is like a raw material to many products and it is interlinked to other asset classes also. So it is very important for us to analyze what really happened, why did the price of this asset fall, and what are the implications on our home economy as well as the world economy. These are the basic topics we'll cover. Firstly, let's have a look at the highest crude oil producers and the consumers. As you can see, United States, Saudi Arabia, Russia were the highest producers per se, whereas US, China, and India was the third largest consumer of crude oil in 2019. The figures given out here are in million barrels per day, and most of the figures which we will see throughout this presentation will be in million barrels per day because that is the convention used in this asset class. So the price of crude oil as on 28th April 2020 was around 27.03 per barrel. And very frankly, the fall in the prices has been huge. So firstly, let's have a look at what was the rise and fall of the oil price when you look at a larger time frame. So in the 1990, the Gulf War mainly caused the oil price to spike suddenly. However, it did see a fall after that. In 97-98, there was a lower demand of oil because of the AFC. So AFC is basically your African Finance Corporation, and they pushed the prices to a low of $10.5. When you go ahead, then the 2008, before that, the in crude oil price, it broke above the $100 per barrel level. And in the global financial crisis, you saw the first big drop in your prices and it actually went down to around 67%. In fact, going ahead, the prices did go up. However, the major factor out here was in 2014-15, where your US shale oil companies, these were the companies which were incorporated in the US and these were the oil producing companies. So because the production of oil increased, they pushed the prices down. And in March 2020, we saw a big fall in prices. Out here, you can see that all of a sudden we saw our prices going from around $60 per barrel to right a little above $20. And even the crude oil futures trend has been in a major negative zone whereby we have seen a huge decline in prices in the months of Jan and March. Now, why did the price crash per se? It was primarily because of the Saudi Arabia and Russia problem. So basically, we have an OPEC group, as all of us know, and there's an OPEC Plus group. So the OPEC Plus group includes countries other than the OPEC economies, and Russia is one of those countries. And the OPEC Plus group wanted to agree on a production cut so as to pull up the prices. However, the production cuts did not materialize because the discussions fell out and there was a huge disagreement between them. Now, what Saudi Arabia did was it went out and it wanted to show its prowess over Russia. So they ramped up their production and they said that they will flood the markets with crude oil, which will lead to a fall in prices. And since Saudi Arabia has been the lowest cost producer, if you look only at the cost aspect, Saudi Arabia has largely been the lowest cost producer of crude oil. So the game was mainly so as to put a pressure on Russia so as to agree on the production cuts. Now, some people also said that it was a move against the shale industries by Saudi Arabia and Russia together. So shale, which is a US industries, they largely have the highest cost per barrel for crude oil. And a fall in prices would majorly dampen their futures and it might also be unviable for them to continue in the future. However, Saudi Arabia and Russia have denied such claims, but some experts say that this can be a move against the shale. However, this plan majorly backfired for Saudi Arabia because uh, of the lockdowns due to coronavirus. The demand for oil went down, and it was a very mistimed approach per se. Now, what happened after the oil price war? Firstly, as expected, there was a huge fall in prices. So the prices crashed nearly 50% for the year. And for South, it was mainly because for Saudi Arabia, people feared that they would ramp up their production to 12.5 million barrels per day. And in the current market scenario, that would be a major aspect to pull market share by lowering prices. Because of that, there was a supply excess. So it was mainly a fear that this excess supply is going to lead up to higher inventories, and the countries are all of a sudden just focusing on having a greater market share and to push each other out of the market than actually look at stabilizing the market and having a price support. This, as expected, very first impact was on the US shale because their costs go up to nearly $50 a barrel. And if we saw in the previous slides, the price was around $27. So they are actually at a huge loss currently. And for small scale shale players, it was a big problem because most of the budgeting was done looking at double of the WTI crude prices compared to the current ones. So there was a huge decline in the credit ratings. So this mainly led to a banking crisis. So you have your JP Morgan Chase, Wells Fargo, Bank of America, Citigroup. What these guys did was they started setting up their companies so as to take on these distressed assets of the US shale companies and trying to restructure them. In fact, Whiting Petroleum Corporation was the first US shale player to file for bankruptcy on the 1st of April 2020. Now, whenever you look at your crude oil price, you can look at it as a cost versus sale. However, it is better that you look at it from a fiscal break-even price point of view. The main concern out here is that if you look at major oil producing countries, except of course, if you look at US and Russia, those two also are into other products. But if you look at OPEC, so these guys are primarily into oil, and that's how they drive their government budgets. So for them, the cost is not only the cost of production per barrel, it is the financing needed for the budget, so for the country to run ahead. So I have the 2017 data as of now. In that, for Saudi Arabia, the cost fiscal break-even price per se was $88 per barrel. In fact, somewhere in the current scenario, also they are nearly around $80 per barrel. Why is it so high is mainly because of the 2014-2016 oil price war again, which they played with the US shale players so as to push them out of the market. And because of that, they have higher payables, and hence their fiscal break-even price is quite high compared to others. Russia was around $53 per barrel. Currently, it is around $40, and US shale is also around the same price. So finally, these countries on the 12th of April 2020, they entered into an OPEC Plus agreement. So it was mainly the OPEC Plus group and other countries. The OPEC Plus group agreed to cut down their production by around 10 million barrels per day. And the other countries also said that they would support the OPEC Plus agreement by cutting their production by another 10 million barrel per day. So a total of around 20 million barrel per day. And however, the other countries, for the other countries, it's non-binding. And this is mainly to regulate the oil prices and to ensure that the industry remains sustainable in a long term per se. So the discussions went on for around a week. And we had Mexico, which was not agreeing to the 400,000 barrels per day cut, citing reasons that it would be unsustainable for the economy. And they were agreeing to around 100,000. So in the end, US stepped in and they said that the differential 300,000 barrels per day cut would be handled by them. So the objective again is mainly to provide a price floor to your falling crude oil prices, and and to ensure that with the fall in demand due to coronavirus, you are actually able to sustain this industry. Looking at the global demand scenario, if you look at this graph out here, you can see that the oil demand growth year on year has been falling, and it has fallen by a huge margin for March 2020. Ahead of this are the forecasts. So they are expecting a V-shaped recovery. However, there will still be a contraction of global oil demand. And this is mainly looking at if the lockdown does not continue for a long period of time and if the economies can go back to a close to normal scenario. So the overall demand fall was around 9.3 million barrels per day in 2020 is what they are forecasting. As a comparison, in 2019 demand was around 99.9 million barrels per day. For 2020, you can expect somewhere around 90 million barrels per day. In fact, in April itself, they are saying that the demand is going to be down by around 29 million barrels per day. And that is going to be a huge hit to these guys. This is the global oil demand forecast. So if you have a look out here, compared to the previous estimates for 2020, all of them have seen negative revisions. Now the supply scenario. So firstly, the supply cuts. So the deal between these countries states that there will be supply cuts incorporated by all of these countries because they want to actually sustain in the future. But the point out here is you cannot really rely on it because the OPEC plus agreements are known to be notorious in nature, where they might not really comply with it because there is this industry is very opaque and not so transparent. So for 2020, the expected supply was around 99.39 million barrels per day, and they're saying they'll cut it down by around 20 million barrels per day for the upcoming months, and later they will be increasing their production. These cuts are going to be insufficient. That's mainly because there's a huge uncertainty about how long will the lockdown periods actually go ahead. In fact, the North American oil industry has seen spending cuts of around $50 billion in February 2020. This deal mainly saves shale. That is because we saw that there has been a bankruptcy already in shale, and shale mainly has small scale players who are not so diversified. So the production fall which they anticipated was around 3.5 million barrels per day if there were no cuts by December 2020. Now this will be only by around 1.8 million barrels per day. So they will be able to sustain better. And looking at the Aramco pricing, Aramco is the main company. It's the largest global oil supplier, and it's based in Saudi Arabia, and it is managed by the government as well. So after the deal, Aramco revised its pricing, and for Asia, it has still given deeper discounts. And that is, again, you can see that that is mainly a motive of still pulling on the market share. However, in Europe, USA, and in Russia per se, they have given a relatively flat to incremental price. And that is mainly so as to please those countries so that even their producers can sustain. The short-term outlook out here. Firstly, for the United States, you can expect it to become a net importer of crude oil. So that's mainly because the US shale is going to see a fall in production. However, the demand might pick up after the coronavirus, so they might become net importers of crude oil. Secondly, looking at the oil demand, it is estimated at around 99.37 billion barrels per day. Now, you will say that 99.37 billion barrels per day, अगर तुम्हारा demand है, तुम्हारा supply around 90 million जा रहा है, तो 9.37 million barrels per day का ही फर्क होता है. तो इतना क्या फर्क है? The difference out here is inventories. They already have a huge amount of inventories kept with them, and for them to cut production down is a huge problem because they have to sustain on their fixed costs. And once you cut down production, you cannot really ramp up those oil wells well after the supply increases. It takes a huge amount of cost so as to sustain an oil well as it is. The prices you can expecting around $33 per barrel in 2020 to be the average price. Comparison 2019 was around $64. So again, a huge fall and a huge loss for all the companies. And in the second half of 2020, we can see an average of $23 per barrel. In 2021, we expect it to improve further to around $46 per barrel. The inventory forecast, so the inventory is being built on continuously because they are not really able to stop their production completely at any point of time. So it is going to be the largest in the first half of 2020. It is going to be rising at 5.7 million barrels per day in first quarter of 2020 and 11.4 million barrels per day in second quarter of 2020. Second quarter, again, mainly depends upon how does the OPEC Plus agreement pan out, if the companies actually stand by their words and if they actually agree to it and operate that way. So the oil inventories throughout in quarter 4 2020. That's mainly because we will see that the demand will come back up and your supply cuts will still be in place to a certain extent. So your existing inventories will be used up. Looking at the bond yields, so the yield to worst. Yield to worst is basically if you expect that your bonds can have an early prepayment, and then what is the yield if an investor can get. So this is like the worst case scenario for an investor. So for that, we saw the yield to worst increase to around 23.9% in March 2020. It has been the highest since 2010. If you look at the graph out here, there has been a sudden spike in the yield, which is again showing you that how high risk the sector has currently gone into. Your supply forecasts, again, the world supply is expected to be higher, whereas your OPEC crude production is pretty low in front of that. So you can expect that the other players are going to eat up the market share of the OPEC again. Your consumption forecasts, so the global liquid fuel consumption in March 2020, it has dropped by 11.4 million barrels per day compared to year 2019. And in April, it has dropped. It is expected to drop by 17.1 million barrels per day compared to 2019. So again, what we are seeing is that the industry is going on a backward track out here. And every single month, there's a very high expectation that as the lockdown continues, we're going to see a huge rise in these figures. In 2020, a global liquid fuel consumption is expected to be around 95.5 million barrels per day, which is around 5.2 million barrels per day below your 2019 level. Now, the impact on our country. Firstly, on the economy, the fall in oil prices are a boon in a certain way. They are going to lower your current account deficits. However, on the flip side, a low current account deficit also says that the capacity of the economy to draw foreign fund inflows per se is going to be lower. Now, looking at your inflation. So oil has been one of the greatest aspects historically in determining your inflation. As the time period has gone ahead, we have seen that the share of oil in inflation has reduced. However, if you look at households per se, then it is still an important aspect. So we can see lower inflation levels for 3 months to 1 year ahead. And even in the current lockdown period, where there are transportation curbs, in such a scenario also we are going to see a lower inflation overall. Looking at your fiscal deficits, so there is going to be a higher fiscal deficit because of lower excise collections because the prices have fallen. Again, what we saw was that the government has increased your excise by around 3 rupees a litre. However, that is going to be insufficient and we are still going to see loss to the government of around 14,000 crores compared to last year. The agriculture, so a cheaper oil is going to bring down your fertilizer prices. However, there are unpaid government dues for the fertilizer industries and lower inflation. both of these are going to hurt your farmers and they are going to hurt the agriculture industry. So on one hand, whereas it is a boon for the fertilizer industry, however, for the overall agriculture industry, it is going to have a negative impact. So now your disinvestment aspect. So your government was gonna look at taking BPCL into privatization. However, this looks very unlikely for this year. That is mainly because, firstly, all the global oil companies are going to be cash starved. So at such a point of time, do they really want to go ahead for BPCL is a big question. And also, there has been a huge fall in the pricing power which these global players had because of the fall in oil prices. So because of that, your disinvestment per se for this year looks unlikely. Looking at your oil companies in India, so the falling prices and your inventory buildup have raised huge problems for all of our oil companies. And even if they have storage spaces, maintaining storage spaces and paying out an additional amount, that has been a big problem. And overall, the number of storage spaces are going to be lesser in the future. These are the references. Thank you very much. If you feel this was beneficial to you, and if you feel that this is applicable for your friends or colleagues, feel free to share it with them. And you can follow me on social media where I will be posting weekly updates on various topics like these. Also, if you want to avail a soft copy of the presentation, then I have a form which will be in the description, and you can fill the form and you will have a link through which you can download the presentation. Thank you.